Hello and welcome to the 2024 market review. The last year has been full of ups and downs, and I kind of wanted to take the time. I'll do what I normally do and review every asset class. But before I start, I like to give you a learning, something that you should learn from the previous year. Honestly, the previous few years in the markets. And that is that you need to invest appropriately to the right time frame. So easy it is to get caught up in short-term thinking. What is best for me over the next year, based on the markets, based on what's happening? What should I do over the next 2 years? When in truth, the best decision that you can make, the most reliable decision you can make, is to make sure that you're aligning your money, each dollar, with when and where it would be used. If you don't know when it's going to be used, slightly different. But when you have a plan, when you know, if you're in retirement, in these years we will be taking out this money, etc., you want to make sure that your money is aligned with when it is going to be used. And that is ignoring what is happening today. And that is so true of that's been true for forever, but it's been very noticeable in the last few years with inflation and with the way that bonds, which is typically where low risk investors go, or traditionally low risk investors go, has acted over the past few years. With interest rates rising the way that they had, it means that if you were invested in bonds below, I recommend 3 years, but if you're invested in bonds below 3 to 4 years, money that you needed, then you were significantly down. And the fact is, if you didn't invest the money that you needed 10 plus years away, well, then that money is very unlikely to keep up with inflation over that time frame. So it's really been these last few years have really put a spotlight on not really individual asset choices or investment choices, but really where you choose to put your money, because that is as important as the individual selection of stocks and things like that you choose to put it in. But whether you put it in cash, whether you put it into bonds, whether you put it into stock, whether you put it into real estate, all of them decisions are massive decisions that have really shown and been highlighted over the last few years. So now, that aside, what happened in the markets over the last year? Well, honestly, the first three quarters of the market, first 3 quarters of the year was not great in the markets. It was what we consider relatively flat, but any negative numbers, not a great number. In fact, if you had watched my fully review, you'd have seen a graph that looked like this, or a slide that looked like this. Shows everything down pretty much across the board. And this is really a true testament to time in the markets. And it's not worth trying to time it and figure out what's going to happen. The fact is that when, if things go according to how investors expect them, the markets are going to be relatively flat, maybe slightly positive, slightly negative. If things go significantly better than what people expect, well, then we will see big jumps in the stock market. If we go significantly worse than what people expect, then we will see significant declines in the stock market. And the last quarter of 2023 showed that. So this is how we ended up. The difference is huge. So the stock market, end of the third quarter, down, the Canadian one down 2%, US down 1%, international developed down 2%, emerging markets down 0.8%. Ended the year, Canadian stock market was up 11%, US stock market 22%, international 15%, emerging markets up 6%, global real estate up, Canadian bonds are up, and that's because of the interest rates. So we expected interest rates to start coming down now, and we'll see that later on. But really, it was if you just saw this on a headline, you would think 2023 was actually a very easy year in the markets, when the truth is that it certainly was not. So another reminder that a reason that you want to remain and stay invested for the long term, and the only way you do that successfully is you either get lucky or you align it with the right time frame, which is why I'm stressing that point so much. So these are the longer term returns in in the markets in general. The Canadian markets, when you look at the 5, 10-year numbers, and 10-year numbers are the ones that matter because that's the time frame around that point, is that it's appropriate to be putting money into stocks and just holding it for the long term. Look at the US market and the global real estate, all of it, all of these assets where you participate in the upside of companies has done reasonably well over the last 10-year period. It's significantly better than bonds or cash has. Despite being able to get 5% on cash recently in the last 3 years, let's say, it was still significantly better to be holding developed market stocks. That's how it's been throughout history, really. Okay, so what parts of the market did well? Well, there's a few reasons the stock market goes up that I'm not going to get into, but part of that is optimism, and part of that is actual earnings increases. So the company itself fundamentally increases value. And over the last year, it was a mix of both. We definitely saw earnings go up, which was nice to see, especially after the expected recession. That we'll see whether that comes or not. But a lot of the growth was in optimism. So when markets don't do as expected, you get swings, and that typically isn't led by fundamentals. That's typically led by what people's feelings are at the time, and the optimism in the markets or not. So that's why growth stocks have done very well in the US. A lot of this was actually down to the biggest 7 companies. They call it the Magnificent Seven, I think they're calling it. Nvidia being a huge one of those, with AI and things like that have come out in recent years. So that was a big plus. International developed, higher quality companies that were undervalued did better in the international space. Again, this just shows for diversification, just speaks to diversification. It's why when I say I'm risk adverse, it's not typically talking about the way that maybe you might perceive risk. I don't think it's worth putting all your eggs in one basket and hoping that you pick the correct market to invest in. I think you invest in all of them. Emerging market stocks, again, small companies did really well in the emerging market space. So another reason you could invest there, you invest across the board. Okay, and then fixed income space, and this has been the focus for a lot of people, as it should be. It's been a very wild ride for something that has typically been very boring space. What you'll notice is that the yield curve, I think I've spoken about that in previous videos, so I'm not going to go into it, but the expected return over the next while in the bond market has dropped. So when back in last quarter of last year, the long-term expected return was around 4%. With the inflation numbers that have come out, the expected return is back in line with back in line with what we were expecting a few years ago, which is actually kind of nice to see. It means that they are hoping that inflation comes down. Still wait to see what them numbers look like. But I've definitely noticed that we definitely haven't had the same type of increases in the last 6 months as we did for the last part of 22 and the first part of 23, for sure. Okay, global fixed income and what that looks like. Not really going to touch on that too much, but it's important to say that typically bonds and cash long-term struggle to keep up with inflation. Cash almost has never done it over any investable time frame, and bonds struggle to do it. There have been times when it has done that, and they often come because of taking advantage of ups and downs in the yield curve historically. The only real way to do that is to participate in the upside of companies. Has been the most consistent way to beat inflation. Anyway, so that's the review of the markets. That's kind of what happened. As for this year, a lot of it is still to be seen. I wouldn't say markets are overvalued, but the US is expensive. Not quite the same type of expensive as we saw in end of COVID. A lot more companies, the new valuations that they have are backed by the fundamentals, but we'll see whether we see earnings growth throughout 2024. But again, truthfully, it doesn't matter. Truthfully, the way that you should be making decisions as to where you put your money should be based on when you need it. And that will give you the best chance to be successful in whatever it is that you're trying to achieve. Anyway, as always, if you have any questions, please feel free to reach out. Other than that, I'll see you in the next one.